Hey, everybody, thanks for joining. We're going to give everybody another minute or two, and then we'll get started. Hey, everybody, this is Nathan Brown. I'm the president here at Mountain Seed. We're excited to kick off another in our webinar series. We've got a great guest today, Neil Patel. Let me do a real quick housekeeping note. One of our always most frequently asked questions is about the slides. Here's how you get the slides. Melanie Wittenberg in our office is the one who sent out the invite to you. She's also the best person to email and ask for a copy of the slideshow if you want that. So I want to go ahead and get that out there. We do have copies of this available, and Mel can provide that to you. Also, any of your other contacts at Mountain Seed, I'm sure, can get it to you, but Mel's probably the most direct source if you have a question about that. So let me go ahead and introduce Neil today. Neil Patel is a principal at Reliant Business Valuations. They specialize in business valuation equipment appraisal nationwide, particularly for SBA lenders. We at Mountain Seed do a good bit of work with banks and credit unions that are SBA lenders. Neil doesn't know I'm going to tell this story, but we were sitting down in our office with some SBA lenders, a month ago, and mentioned business valuations, and they said, "Oh, you working with Neil?" And we said, "Yeah," and they were like, "Neil knows everything about business valuations. In fact, when the new SOP comes out, he's the first one on the phone with the SBA and is the source for interpretation of some of those regulations." So certainly Neil is qualified to present. You can see the rest of his bio. We're excited to be early working with Neil and making both equipment and business valuations available in our ecosystem, and I know that this will be a great presentation today from Neil. So Neil, without further ado, I'll turn it over to you to jump in.
Thank you, Nathan. I appreciate it. Thanks everyone for joining the webinar. Nathan, I appreciate the opportunity for me to present to your clients and potential clients, and Melanie, of course, thank you for your assistance as well. So as Nathan pointed out, I do a lot of valuation work for SBA lenders. I'm a certified business appraiser, so this webinar will specifically be about business valuations. We have another webinar scheduled with Mountain Seed next month, which will discuss equipment appraisals. So this one's going to be geared towards business valuations. And my firm is headquartered in New Jersey, but we work with lenders all around the nation. And so a lot of these topics are not, state specific like real estate appraisals are. You can use these multiples that I'm going to be discussing pretty much nationwide. So the topics that I plan on covering today are, first off, we'll start with the SBA SOP guidelines. I know some lenders on here might not be involved with the SBA, but I want to make sure that if those of you that are SBA lenders, you understand when a business valuation is required. And even on the conventional side, some of these guidelines, a lot of conventional lenders use similar guidelines that the SBA proposes when they're doing a conventional deal that involves a business acquisition. So we'll talk about some guidelines, and then we'll jump right into the intangible assets. How are intangible assets calculated? How does the intangible assets impact deal structure? And then the second portion of the presentation is really a good takeaway for everyone on this webinar. What I do is I present two case studies, and we're going to actually go through tax returns of two different businesses. I'm going to show you how we calculate EBITDA, how we calculate an appraiser's cash flow, and then I'm going to actually show you how to estimate a range of multiples so that you can estimate the range of value for pretty much any business. I'm going to use two completely different industries, and my goal here is, when the webinar ends, you should be able to take any set of tax returns, the first page, and quickly glance at it, estimate the cash flow, estimate a multiple, and get a value in your head. And that's not going to be a true appraisal, but at least that provides you with a rule of thumb. And if you're a business owner, then of course it gives you a range of values. And if you're an underwriter or a BDO or business banker, that'll really help you kind of get ahead of the ball and make sure that the business that you're underwriting or that you're dealing with falls within the range of values that's reasonable. And so that's really the goal of the second portion of the presentation. So we'll just go ahead and get started. So when is a third-party valuation required? So this is for SBA, a guideline, and I say non-special purpose property, and I'll explain what that means in a second. But when do you need a third-party business valuation? So for any SBA deal, you're required to have a business valuation, but they require a third-party business valuation if one of the three highlights here are true. If the amount being financed minus the appraised value of real estate and or equipment is greater than $250,000. So if you have a 7A loan, 504, any other financing, including seller financing, if you take the total loan amount and you subtract out the appraised value of real estate and or appraised value of equipment, if there's a gap of $250,000 or more, then the bank has to engage a certified third-party appraisal company. And there's specific designations that the appraiser must have. I'm not going to go through all of them. There are a bunch of acronyms that you may not be familiar with, but it's in the SOP. And just one important note is that a CPA, just a CPA without any business valuation designation, is not a qualified source anymore. They used to be until about 2014. So you have to have a appraisal designation, which is listed out in the SOP. I have 2 out of the 5, I believe, that are available. But the key here is that there's no mention of goodwill. So you don't want to look and say, hey, I have more than $250,000 in goodwill. It's really your loan amount minus appraised value of assets or hard assets. So regardless of the loan amount, if there's a close relationship between the buyer and the seller, and they give some examples between family members or business partners, which we see a lot of recently. One that we see more frequently as of late is an employee-employer relationship, where the employee has been there for 5, 7, 10, 15 years and is now buying out the employer. There was a lot of deferred planning due to the Great Recession, and now that financials are looking much stronger, you have a 4 or 5 year upward trend in revenues and earnings, we're seeing a lot of employees finally buying out their employers. So in that situation, that's considered a close relationship. You still need a third-party business valuation. And then, of course, on a conventional deal, if your internal policies required an internal business appraisal, then you would also need it for the SBA deal, regardless of number 1 or number 2. And so again, if none of these trigger a third-party report, you still have to do an internal valuation. And the latter part of this presentation is going to really assist you with figuring out how to do that. And we have products that are going to come out eventually that will assist with the internal valuation as well. So when does a valuation expire? So that's a frequently asked question. Probably get that once or twice a week. And so I always put frequently asked questions and topics into my presentations. And it's relevant here because obviously Mountain Seed works a lot with real estate appraisals. And so, as you probably know, a real estate appraisal, it expires 12 months of the application of guarantee. In the SOP, they just added that an equipment appraisal now expires within 12 months of the application. And business valuation, however, they remain silent. And so what they have confirmed, what the SBA has confirmed, is that they want an accurate value of the current business. So why wouldn't they just put 12 months or 6 months or whatnot? Well, the reason, I believe, would be that the value of real estate doesn't typically fluctuate more than maybe 10% in 1 year, unless there's some environmental issue. Similarly, the value of equipment shouldn't just drop more than 10, 20% in 1 year, but the value of a business overnight can go from $1 million to zero, right? And we've all seen that with what happens with Tesla stock or Facebook stock when something happens, or the CEO of Twitter says something and all of a sudden the stock drops. That's one of the main reasons that the SBA doesn't want to put a specific deadline, because the value of business continues to change, and so it's up to the lender, following prudent lender policy, to determine whether or not it's time to update the report. So my suggestion to my clients is always 12 months should be the max, because you should never stretch it out beyond what they've set in for equipment and real estate. But it's just really prudent if you have anything past 6 months. Let's say you ordered a report from us and it's dated December 31st, 2017, and you're looking to finally close your loan, and you're going to obtain June 30th financials shortly. Take a look at the June 30th financials, annualize them, and make sure that the annualized projections match up with what the appraiser's projections were back in 2017 for 2018. And if the revenues are down and earnings look like they're down, you should definitely get an update. And if everything looks great and the appraiser projected $1 million in sales and you're looking at annualized sales of 1.5 million or 1.2, then you should document that. Don't just say, okay, it looks good, here it is. I would highly recommend that you document your work file and say, hey, listen, appraisal is dated within 6 months or even 4 months. I mean, the more that you document your reasoning, the less you have to worry about later on in the event of a default. And you're not going to remember this 2, 3, 4, 5 years from now. So just document, here's what we talked about. And then, of course, depending on the appraisal firm that you're working with, you can send over the most recent financials to the appraiser, and the appraiser should be able to just go over it with you and say, yeah, this doesn't look like it needs an update, or yeah, our projections or management's projections were way off from what actually occurred, and therefore you should get this updated. So that's really important. That comes up all the time. So now let's talk about special purpose property. So if you saw in the first slide, a business valuation for a non-special purpose property, here's the requirements. For a special purpose property, let's figure out what the difference is between the two. So, and the Mountain Seed clients here are going to find this information pretty useful, because special purpose property is defined in the SOP as a limited market property with a unique physical design, special construction materials, or layout that restricts its utility to the specific use for which it was built. So here are examples, and as you can see, car wash business with real estate, farms, hotels, motels, lodging facilities, marinas, nursing homes, anything that I've highlighted in red are more common, deals that we've seen. Anything that's in blue crossed out is from the previous SOP, which now they have they've removed it. But the point is, if you are financing a hotel, then that is considered a special purpose property. Therefore, there's a specific rule. A hotel is just one example, but if you're financing any one of these properties, there's a specific rule that needs to be followed, and that rule is the lender must obtain an independent, and they use the word business valuation in the SOP, which I'll be talking to them about, because real estate appraisers don't perform business valuations and vice versa. So they changed it from real estate appraisal to business valuation in January. So I think that was probably an incorrect change. But the point is, the lender must obtain a real estate appraisal performed by a certified general real property appraiser, and that appraiser must follow these 3 points. Number 1, the report must allocate separate values to the land, building, equipment, and intangible assets. So if you are financing a hotel, your hotel appraiser must separate out the land, building, equipment, and intangible assets. I've seen multiple times where the real estate appraisal for a hotel doesn't separate out the intangible assets. Even if they're just going to assign 0 value to it, they have to specifically separate the value out and put it there. And in those cases that they don't do that, the SBA will kick it back if it's a general processing load. Number 2, the general real property appraiser must have completed no less than 4 going concern appraisals of equivalent special use property as the property being appraised within the last 3 years. So now here's where it kind of gets tricky. You're looking for a car wash appraiser. You call me and you say, Neil, I have a car wash with property. I need it appraised. And I say, well, I can't do it because it's a special purpose property. You need to find a real estate appraiser to do it. Now you have to obviously call Mountain Seed or call your real estate appraisal and say, hey, not only do I need this, but I also need to make sure you've done 3 of these or 4 of these in the last 3 years. Can you send me all this proof? So it's very prudent to obviously have this list ahead of time. And my suggestion would be to make sure that all of the real estate appraisers that you're working with, they have this list and they provide you with, circle each one of these that you have done 4 evaluations of these, each one of them within the last 3 years, and then make sure that that is clearly identified in the qualifications portion of the report. You don't want to, again, search 3 years from now and say, oh man, I need to find proof that this person, appraised 4 hotels 3 years prior to the report being issued. All that should be in the report, so you can pull it up and say, here you go, SBA. This is what this shows that this person was qualified. And then, the last one is it has to meet USPAP guidelines. Most, if not all, your real estate appraisals will meet USPAP. So the confusing portion here is that it says business valuation in each line, but as you know, a business appraiser will never appraise land and building, and so you have to basically find someone that's a real estate appraiser that has experience to separate out the intangible assets. So that's a really important point for special purpose properties if you finance any one of these property types. Gas station is not highlighted, but gas station is probably actually the most popular one on here, where there's a gas station with real estate that's being financed. If the gas station or car wash does not have real estate and it's leased from a third party, then you can go ahead and give us a call and we can do the business valuation on it. But anytime there's real estate attached to any of these properties, you're going to need a real estate appraisal. So let's talk about the equity requirement for a business acquisition. So, typically I would, if I was in front of an audience right now, I'd ask for a raise of hands to see how many lenders, finance change of ownership loans for business acquisitions. But in this case, I'll assume that at least half do, and so this is relevant to you. The minimum equity requirement for resulting in a new owner, there used to be a 25% equity injection requirement, but as of January 1st, it is now 10% of total project costs. So the borrower has to inject 10% of total project costs. The project costs are all costs required to complete the change of ownership, regardless of the source of funds. And so if you need, if you're buying a $1 million business, and you need $100,000 of closing costs and another $100,000 of working capital, your total project cost is $1.2 million, and the borrower needs to bring in $120,000 for that to be eligible, or for that to meet this requirement. Now, out of that equity, the seller debt may not be considered equity unless it's on full standby for the life of the loan and it does not exceed half of the required equity injection. So if 10% is required on $1 million total project cost, then that's $100,000 equity injection required, and only half of that, or $50,000, can be from the seller. And because you're considering that equity, it has to be on full standby for the term of the SBA loan, which is much different than the prior iteration. So this is really important to figure out. Now, the reason that they didn't just simply put the seller's note can only be 5% out of the 10% is because if the bank requires 20%, if the minimum equity injection requirement from the bank is 20%, then now you've just upped the seller requirement from, up to half of that. So the seller has to put in 10%, out of the total 20 on full standby. So, just remember it's 10%. We work with over 100 lenders, and most of them are still requiring, most that I see when I look at a credit write-up are requiring more than 10% down on a change of ownership deal, unless there's certain synergies or if the buyer already owns a similar business. I don't really see too much, leveraging up of small businesses because, it just dropped from 25 to 10. And so I don't think lenders are just going to all of a sudden start saying, okay, 10% down. I think that's risky for certain deals. So now talking about intangible assets, if any of the loan proceeds will be used to finance intangible assets, the amount must be specifically identified in the use of proceeds section of the application and the authorization. So let's talk about what that means. Essentially, what the FBA is saying is you need to separate out the value of intangible assets and tangible assets in your use of proceeds. So that's simple enough. How do we do that? We need to know the definition of what the SBA considers intangible assets. And so in the specific scenario, it's pretty straightforward. The definition here is straightforward, but let's break it down. The value of intangible assets is determined by the value of the business as identified in the business valuation minus the sum of working capital assets and fixed assets being purchased. So just go down to the intangible assets equals business value minus working capital plus fixed assets. So there's a formula here, and so what we have here, what we provide the client is the value of the business value. So let's talk about how this actually translates to on a table. So this is a table that we include in all of our reports. It's on page 3 of our report, and you'll notice that the final value of the business that we appraised is worth $700,000. Now, what does that value include, right? So that value includes inventory, fixed assets, and that's it. There are no liabilities included in that. So this is based on probably a typical asset sale where you're buying a restaurant and you're buying inventory and you're buying fixed assets and goodwill, and that's it. So in this scenario, if you look back at this formula, intangible assets equals the value of the business minus working capital, which is current assets minus current liabilities, plus fixed assets. So let's take a look at the $700,000 is the value of the business. Let's calculate the working capital. So in this case, you have $50,000 of current assets and no current liability, so your working capital is $50,000, and your fixed assets is $100,000. So you have $700,000 minus $100,000 equals $550,000. That's your goodwill, and intangible assets can include goodwill. It can include the value of license, a liquor license, a copyright, trademark, patent, customer client list, the non-compete. All of those items that I mentioned, plus a whole bunch more, are all included in intangible assets because those are not tangible. You can't touch them and sell them without valuing them. So that is the way you calculate intangible assets. Now, one thing I want to point out is certain asset transactions will still include the transfer of liabilities. So if you have a restaurant and you want to sell your inventory, your equipment, and your goodwill, but there's, let's say, a line of credit for, well, you know what? I'm gonna go to that next. I'm sorry. I'm gonna talk about the equipment first. The fixed assets, we use net book value because that's what the SBA requires the business appraiser to use, unless there is an equipment appraisal. So let's say you engage Reliant or any firm to do an equipment appraisal. We will take that equipment appraisal, we'll look at the fair market value reported in that equipment appraisal, and we can swap out the net book value for the appraised value, the fair market value, as per an equipment appraisal. So what does that do? It doesn't do anything to the final value. Note that if you have fully depreciated equipment or you have equipment worth $250,000, the value of the business is still the same. It's just that your intangible assets go down because now you have $300,000 of tangible assets. So 700 minus 300 equals $400,000. And so your intangible assets go down, nothing else changes. So we often get the question, hey, Neil, you valued this limousine transport company for $500,000, but now we have an equipment appraisal and the book value of cars was only $50,000, and now we have an equipment valuation showing it as $150,000. Does your $500,000 value go up? And the answer is no, because the cash flow still remains the same. The equipment that's required to generate the cash flow is always included in the value of the business. And so all it does is kind of decrease the value of intangible assets and increase the value of tangible assets. So going back to the other example I said, if you're assuming liability here, let's say you're assuming a $100,000 account payable or a line of credit, notice that the goodwill does not get impacted. So if I were to buy a business and I were to you were to say, I'll sell it to you for 700, and you said, oh, by the way, here's another $100,000 of liabilities that I want you to assume, then what happens is, on this debt-free scenario, the value of the business is 700. If I'm going to assume a $100,000 liability, the value of the business drops to 600,000, and now I assume your liability. So the value of the business drops dollar for dollar based on the liability that I assume, but it has no impact on the intangible assets because the customer list, the goodwill, all that's worth the same, irrespective of what liability I'm going to assume. It's just the overall value of the business goes down. So, the one of the questions I get from SBA lenders is, hey, we're trying to design or structure our use of proceeds table, but we don't have a business valuation yet. How do we figure out the intangible asset value? We don't have your table here that you include in the report. And so, the answer is essentially on the bottom of this. You take the purchase price and you take the tangible assets as per the most recent balance sheet. So your balance sheet is going to look like the table right on the top, because the table on the top is from the actual balance sheet. So you take the tangible assets, 150,000, and you subtract it right out, and you'll get 550,000. Now, this is obviously assuming that your purchase price appraises out to the final value. But at least you can structure the deal accordingly, and then you can explain to the borrower that if there's a discrepancy in the business valuation compared to the purchase price, there's going to be an adjustment required in the use of proceeds. And the adjustment was more important when the 25% equity injection rule was around, because that was whenever intangible assets are over $500,000. Now it doesn't matter what intangible assets are. Any BIS Act requires 10% down, and so this use of proceeds may not be as applicable. But regardless, if you recall, it's still in the SOP, which is a brand new requirement, which says you have to split the intangible assets you have to specifically identify the intangible assets being financed. So you still need to know how to calculate the intangible assets, and you need to put that in your use of proceeds. So now, one final portion of the guidelines part of this presentation is really the transaction type. This is something that a lot of SBA lenders have kind of overlooked over the years, and when I talked to the SBA about 2 years ago, the ex-director at Citrus Heights basically said, listen, you need to point this out to the lenders during your presentations, because what they're seeing is the business valuation doesn't include the assets and liabilities that the lender ends up financing. So the SOP specifically states the scope of work should identify whether the transaction is an asset or a stock purchase, and be specific enough for the individual performing the business valuation to know what is included in the sale, including any assumed debt. So as you saw in the previous slide, it makes a difference. If your borrower is assuming a $100,000 liability, there's a big difference between $600,000 and no assumption of debt, which would be $700,000. So that's the point that they're trying to make, that all assets and liabilities that are included in the transaction has to be included in the business valuation. And this is similar to comparing apples to apples. The reason that this doesn't always happen is because the business appraiser will get an LOI to purchase, or a draft purchase agreement, or maybe no agreement at all. And we have to ask the questions, hey, is this going to be structured as a stock or an asset sale? What are you including in your transaction? And then we estimate, the value based on what we're told is included or excluded. But then the deal structure changes 3, 4, 5 weeks after we've submitted the report. So it's up to the lender to understand how to read the business valuation, make sure that the appraiser that they're using has something similar to this, or something that allocates each portion out, which clearly shows in this scenario inventory and current liabilities and fixed assets are included in this transaction. And that way you are, if the day before closing you look at this and you say, wait a minute, the LOI to purchase said it was a stock agreement, and this is a asset sale which doesn't include any liabilities. You need to get the business valuation updated to match the actual deal structure, because deal structures change, as everyone knows, if you're a lender, all the time. And you'll be lucky if you get a purchase agreement, more than 24 hours before closing, that's, fully signed, dotted, and ready to go. Aside from that, there's going to be amendments and changes throughout. So it's really up to the lender. It's nothing that the appraiser can do aside from just structuring it correctly the first time. And then if there's changes required, you need to change it. But one thing I want to point out, a stock transaction and an asset transaction, what are the differences? An asset transaction really means that you're buying specific assets from the company, and that's it. So if Mountain Seed LLC is selling its assets, and Nathan has a separate company, Nathan LLC can purchase certain assets from Mountain Seed. If it's a stock transaction, then Nathan doesn't make Nathan LLC. Nathan's just going to go in there and say, hey, well, it's a bad example because Nathan's the owner of the other Mountain Seed, but there's going to be a change of owner of the target LLC. The owner changes, and that's it. There's no new company that needs to be formed and then acquire assets. So a stock transaction can be structured in different ways, though. So in a stock transaction, I might only assume cash, inventory, and FF&E. And even if I'm buying the company's stock, my contract says that I'm not assuming any liabilities. Conversely, in an asset transaction, I might still assume liabilities, like the example that I gave. So just because it's an asset transaction doesn't mean automatically that the appraiser should assume, all right, this is structured typical inventory and FF&E, and if it's a stock transaction, include all assets and all liabilities. Regardless of how it's structured, asset or stock, each and every single asset and liability has to be, it has to be determined whether or not that's included in the transaction. Oftentimes, you're going to see stock transactions when a license is involved, when there's either a medical license or a government license, or if there's large contracts, then the buyer doesn't want to form a new company and then have to redo all the contracts with the vendors and suppliers. They're just going to want to kind of slide right in, change the ownership structure, but keep the company's name the same. At the same time, they don't want any liabilities, so they can structure it that way. So there's some examples which I'm going to skip over because I think the fun part of this presentation is really figuring out how to value a business. Now that you kind of know the basics of what's included and how intangible assets are estimated, let's go backwards and figure out how do we get to that $700,000 value in the first place. So slides here, the following slides are going to talk about valuation methods, reasonable valuation multiples, factors that impact value, and a range of multiples. So first, we have a case study of a liquor store. So I'm going to show you how to calculate seller's discretionary earnings and find all the appropriate add backs. And then we're going to discuss what the difference is between a lender's and appraiser's cash flow. And finally, we're going to talk about rule of thumb values using the market approach. So let's start out with this liquor store. Just take a few seconds to take a look at this. We have $2 million in revenues. We have gross profit of about $500,000, and then we have our typical expenses, and we have income of about $100,000. So we have EBITDA, which is calculated the same way that the lender would calculate EBITDA. You're going to take your net income, $90,000, and you're going to add back interest, taxes, depreciation, and amortization. So all you need for this exercise is really page 1 of the tax return, and you also need the other deductions. If you look on line 20, it says other deductions attached statement. For every tax return type, 1065, 1120, 1120S, and even a Schedule C are going to have an other deductions page. And the other deductions page will always have amortization on it, if there's any on there. So you have to have that, otherwise you won't capture the non-cash expenses. So in this case, we have interest, clearly delineated, depreciation. Don't forget, if there's any Section 179 depreciation, it's not on this. It's going to be right on the K1, so don't add that back double. We're just going to add back only what's on this tax return on the front page. And then what we're going to have is taxes. Let's talk about taxes for a second. We don't want taxes. We don't want to add back the taxes that are on line 14. Those are payroll taxes. So don't make the mistake of adding back taxes. You want to make sure that in a 1065 LLC, it's a pass-through entity. There are no corporate taxes. Same as an 1120 S Corp, there's no corporate taxes. So you're adding back 0. In an 1120, a C Corp, there's going to be net income, and then there's going to be taxes, and then there's going to be net income after tax. If you're just using the net income before tax, then there's no tax to add back. So, and then in Schedule C, again, there's no taxes as well on a corporate level. So just don't make the mistake of adding taxes back. That's one mistake that we've seen lenders do on a rule of thumb analysis. And then amortization, 40,000. So we have EBITDA of 190,000, and that is the same way that you as a lender are going to calculate your EBITDA. Now let's talk about seller's discretionary earnings. The acronym here is SDE. It's a universally known acronym amongst business appraisers and certified business brokers or business intermediaries around the nation. So if you're dealing with a broker, they're going to know the acronym SDE as well. And what SDE is EBITDA plus the owner's compensation plus any normalizing adjustments. So normalizing adjustments are going to be non-recurring expenses, non-business related expenses, owner's perks, and rent adjustments. So essentially what it is, it's the true cash flow to the owner as an owner-operator. So in this specific case, we are going to we're going to add back the owner's compensation, and the owner's compensation is included in the salaries and wages here. And so we're going to ask for a W-2, and we see that the owner is paying himself or herself $15,000, so we add back to $15,000. But before we get into the others, let's talk about what we do not, or what typical add backs are in general. So we have owner's compensation, and the reason we add this back is because as an owner of a liquor store, let's say if I own a liquor store, I can either pay myself $15,000 a year, I can pay myself $50,000, or I can pay myself $0. Because I'm the owner, it's at my discretion. But we shouldn't, the cash flow shouldn't be impacted based on how much I pay myself. So you want to add back whatever I'm paying myself to the net income or the EBITDA. This one's an important one. The next one, manager salary. So if it's an absentee-owned business and there's a general manager working there full-time, seller's discretionary earnings assumes a full-time owner-operator. And so if we want to normalize SDE across the board and we want to multiply it by a certain valuation multiple, we want to get to an owner-operated cash flow stream. So if I'm absentee and I have a GM running the business, then technically you should add back not only my salary, but you should add back the general manager's salary as well. Because then your cash flow stream is based on someone that's going to work full-time as an owner-operator. So we would request the W-2 of the general manager. And then, of course, related payroll taxes, we estimate approximately 11% in employer expenses for payroll taxes, which includes, unemployment, FICA, FUTA, those items. And then any discretionary expenses. So if the spouse is being compensated for the business, but he or she is not involved, if there's a personal automobile. Now, here is where we get a little picky. If you have a construction contractor, or let's say an electrical contractor, and you're telling me that your Ford F-150 is a personal vehicle, it's highly unlikely that we'll add that back. But if you have a dental practice and you have a $1,000 a month Mercedes payment, and you're telling me that's a personal vehicle, we'll add that back because you don't need a vehicle for a dental practice. So we're going to use our discretion there, and there's other items as well. But occupancy is another item. We'll talk about that probably in the next slide. Any non-recurring legal fees, non-recurring consulting fees, oftentimes we'll see a valuation expense in the interim period or a business broker expense. Legal fees may rise in prior years because something happened that's non-recurring. We're going to add those back, and we'll probably normalize them to be similar to previous years. And then, of course, any unrelated income. You have insurance reimbursement for a fire, or you have an affiliate company paying, pass-through income through this company. We're going to take all of that out because what we want to get to is really an income stream that a potential buyer is going to see. So if you have anything that's not recurring, that's never going to happen again, you don't want to include that in your valuation. And then, of course, like I mentioned, transactions with affiliates. So what we don't accept as a general add back is advertising and marketing. If you had, Yellow Pages expenses and you said, that didn't work and we want to add those back $10,000 a year, it's impossible for us to know what revenues were generated from that advertising, and so we can't just add that back. So we typically don't adjust for marketing unless it's a specific scenario which makes sense. I'll skip the rent. I'll talk to you about that in a second. Cost of goods sold or salaries. Oftentimes, a buyer is going to look at a business and say, well, wow, the COGS are so high compared to the industry average. I can just buy that business and I can fix it. I can adjust it out to, industry average. However, we don't make that adjustment because a underperforming or inefficiently run business is worth less than an efficiently run business. It's not as simple as just saying, hey, salaries and wages are high, I'm going to fire half the people and I'm going to get it right. I mean, if you own a business or if you've ever been part of that, you know that it is very difficult to change the expense structure of a business. And all that is equity, it's sweat equity that you're putting in. And so we don't make that adjustment. Sometimes lenders do it on their end, but for projection purposes. But for a fair market value of a business, it's almost like as treating it as a real estate perspective, it's an as-is value. So if it's run inefficiently, then it's going to get an inefficient price tag. And then synergistic add backs, if you have a distribution company and your borrower is buying another distribution company, as a lender, you're going to want to see what synergies there are. There might be cost savings, and you might be able to save on salaries and wages, or you might have facility savings where you can shut down the location. But from the SBA standpoint, they still want the fair market value, assuming a hypothetical buyer, hypothetical seller. And so we are not going to make those synergistic adjustments. Typically, a synergistic value is going to be priced higher than a fair market value because there's, the buyer has certain synergies. So we don't make those changes. And then travel expenses, meals, in most cases, we don't add those back because we don't know whether or not they're business related or not. So let's go back to the tax return. We have EBITDA of 190. We have owner's compensation of 15,000. There's some non-recurring expenses being paid from the business. It's the owner's health insurance, about $500 a month, so we annualize that. And now let's talk about the occupancy. This is really important, especially because there's a lot of lenders here on this call that deal with real estate appraisals or real estate in general. If the liquor store is located in a retail location which is also owned by the same owner as the business, in this case it's an EPCOC, but anytime there's a related party that owns the real estate, you have to adjust the rent to be fair market, because as the owner of a liquor store, I can pay my holding company $144,000, or I can pay $0, or I can pay $300,000, and that's going to completely change the cash flow of my business, and that's really not fair to a buyer. The buyer wants to know what's the fair market value to a hypothetical, buyer seller. So what we do is we add back the rent expense, if any. Sometimes the real estate might be owned by the business entity, and they can't pay anyone rent because they own the real estate. At that point, we add back $0, but then we still have to subtract out a fair market rent. And how do we subtract out fair market rent? The first and most efficient way is to look at the real estate appraisal. We look at the income approach, and the income approach of a real estate appraisal will say, here's the potential gross rental income for this property, and well, guess who pays the rental income for the real estate? It's the business. So you have to, if you're going to take income on the real estate appraisal side, then you have to expense it somewhere. You have to expense that on the business side. So you have $100,000 of expense. Another way to do it if there's no real estate appraisal available is we take the total square footage and we estimate the rent per square foot using LoopNet. We have commercial access to LoopNet, or you can you can engage your local real estate appraiser to just give you an estimate of what the fair market rent is in the area, and or price per square foot. You can Google it. You can use Zillow. I don't think Zillow has commercial actually, but you get the point. And you basically just multiply $20 a square foot times 5,000 square feet, and now you have separated out the real estate completely from the business. And that's the key here, is that the lender wants to know what's the value of the business and what's the value of the real estate. And if I want to add the two, I can add the two together, but I don't want any overlap. And so you want to make sure that the expense on the business side is the same as the income on the real estate side. So now we have seller's discretionary earnings of $250,000. That's the number. That is the magical number there, SDE. And so here is the difference between our valuation, our cash flow calculation versus the lender's. We got to a $250,000 SDE, and the lender, they added back owner's compensation, but they also deducted a buyer's required draws. Let's say the buyer has 3 boats, 2 summer homes, and a bunch of debt, and they're going to be required to take a $65,000 draw to cover their global debt service coverage ratio. Well, in that case, that has nothing to do with the business, right? That shouldn't have any impact on the value, the fair market value of the business. It's just the buyer's required draw. And so we don't do that type of adjustment. Now, the rent being paid to an affiliate holding company, well, if it's an EPCOC transaction, the lender is just going to add that rent back because that's all part of the global debt service coverage cash flow. And for us, like I mentioned, we want to split that out completely from the real estate appraisal, so you can add the value of the business to the real estate appraisal. So we don't do that. So there's a significant difference there. One additional point I wanted to mention, I've been talking about SDE a lot, but another income stream that we use is adjusted EBITDA, and what that does is it assumes after doing all these adjustments, you get to 250,000 SDE. You assume that you're going to replace the owner now with a general manager at fair market. So the general manager at a liquor store fair market would be 35,000, and so we have two income streams. We actually use EBITDA, EBIT, SDE. We use multiple income streams, but we're going to focus again on SDE. But I just want to mention that that's the adjusted EBITDA is a little different. We do consider fair market replacement for the owner as well. So now that we have $250,000 in SDE, what do we do? Well, there's three ways to approach to value a business, and those are the three same ways that you can appraise real estate. You have the asset approach, the market approach, and the income approach. Every business valuation should discuss each one of these three approaches. Otherwise, they have to disqualify them. Just like real estate appraisals, on the engagement letter, you're going to say, hey, we require you to use the income, market, and asset, which is like the cost approach. So the asset approach, if you probably know, is like the build-up method. How much does it cost to build the building? Well, it's the same thing for the business. It's just going to look at the balance sheet. We're going to look at the tangible assets on the balance sheet, and that's it. That's the value of your business, and that's always going to be the floor value. I mean, if your business is worth nothing pretty much on a going concern, then it's worth what the assets are worth, and it's worth more in liquidation than a going concern. The income approach is similar to the real estate, where it's a little different from real estate in that real estate has significant cap rates that they can get from the market based on transactions. In business valuations, we actually create the cap rate based on industry risk premiums, company-specific risk premiums, risk rates for borrowing money, and so we have to create a discount rate, and that's more subjective for bigger businesses. So we're going to focus on the market approach. The market approach is essentially like when you're buying a home. If I'm buying a home that has 3-car garage and the house next door just sold at $500,000 with a 2-car garage, then I'll pay maybe $520,000 or $525,000 because I get one more garage. And so similarly, the market approach takes actual closed transactions. We have subscriptions to about 90,000 transactions that have been closed. They're input by business brokers, and we know what the price they sold at is. We know what the revenues are. We know what the earnings are, so we can create multiples. You have a price to sales multiple. In this case, let's just use it 45 cents on the dollar sales multiple, and so the value of your business is $900,000. But the problem with this is it doesn't take into consideration any variable expenses like rent, COGS, salaries, and wages. You don't have any of that in here. So if I have a liquor store doing $2 million in sales and Nathan has one with $2 million in sales, but my COGS and labor are through the roof, clearly his business is worth more than mine. So this is a rule of thumb at best, but we very rarely put any weight on the price to sales multiple in the market approach. So here's the one that we put the weight to, and here's what borrowers look at. Here's what lenders care about. It's all about the earnings, right? So we get to the SDE we get to SDE of 250, and we have to apply a price to earnings multiple. And here's, this is not an actual multiple, but just hypothetically speaking, you put the 4. So let's talk about now, where are we getting this multiple from? We have 10 minutes to figure out where we get a multiple from. And so what is a multiple? The way that I like to talk about a earnings multiple is how many years is it going to take me to pay back my business? That's what a multiple is. If I have $250,000 in cash flow and I'm willing to pay 2 times that, it's going to take me 2 years to pay my money off if I buy it, if I buy it for cash. If I buy the business for $500,000 in cash, 2 years later I'll make my money back. Conversely, if I pay 5 times, then it's going to take me 5 years to pay my money back. So why would I pay 5 times or 2 times? What's the difference? Well, in this scenario, if 250 times 2 would be 500, that's a 50% ROI versus a 25% ROI. Here are the factors that influence that multiple. Now, it's not in the presentation, so I want to make sure everyone jots this down somewhere. The median price to earnings or price to SDE multiple across all 90,000 transactions is approximately 2.75. So that is your median. Now let's start with 2.75 and let's talk about the influences that I have here, the factors, and let's talk about a liquor store. So how involved is the owner in a liquor store? As you probably know, there's very little involvement from an owner. You might not even know the owner of your local liquor store. You kind of know who the employees are and where your favorite drink is. That's about it. So that leads me to so that's a strength, right? So you start at 2.75 and you add, let's just say, there's no math to this, but let's just say you add 25 basis points. Transferability of revenues, what does that mean? That means if your liquor store down the street that you visit sells to another person, will the revenues be impacted by that sale? And so how many of you would stop going to the liquor store because it's sold to a third party? And the chances are that many of you probably wouldn't even know. And so that's not a risk. That's actually, there's very little risk there, so that's a strength. So you add a little bit more to the multiple. Size of potential buyer pool. Let's talk about how many of us on this webinar are potential buyers of a liquor store. Mostly all of us are, as long as we're over 21, we can buy a liquor store. Customer concentration, there's very little concentration. And industry and company risk. So there's very little industry risk here. If someone's born, someone passes away, if the stocks go up, the stocks go down, no matter what you're drinking. So that's the liquor industry, and so there's very little risk in the liquor industry. And then ease of operations is another one. It's fairly simple and straightforward to own and operate a liquor store. You just have to have good inventory management, and you have to have a competent staff that can check IDs and keep the store clean. So because of those examples here, we have a higher multiple. You start at 2.75 and you're going to start going up to 3 to 4 times. We do a ton of valuations for liquor stores in Georgia. They generally fall in the 3s. If we start talking about New Jersey or Massachusetts where there's license value, you're going to start looking at the 4s, and so on and so forth. So now I like to contrast this with a completely different industry to really give you perspective on where to figure out what a multiple is. So let's go back to the 250 for a second, and let's talk about a dental practice. Now I'm going to do the same exercise, but I'm going to skip a few items, obviously. But let's get to the SDE here, okay? The EBITDA is interest, taxes, depreciation, amortization. So you have right here in green, you see it's $295 or approximately $300,000 for a dental practice that's grossing about $1.3 million in sales. Let's calculate the SDE. So what does that mean? We are going to take, number one, we have other income, and that other income is non-recurring income. In this specific scenario, believe it or not, you have a $7,000 non-recurring sale of gold fillings that the doctor collected over like a 15-year period, which kind of sounds gross when you think someone's wearing a necklace made out of gold fillings. But that is non-recurring. The buyer is never going to see that money again, so we're gonna adjust that out. We have compensation of officers. The officers being compensated $185,000. That's an add back. We have owner's perks. We have $7,000 of profit sharing that's going straight to the owner, and so that's a discretionary expense. And then we have, like I mentioned, non-recurring gain. I put equipment there, but it's really fillings. And non-working spouse. We have a spouse that's being paid $25,000. We have to get proof of that. We get the proof of W-2, and we add that back. So we have a $500,000 in SDE, and a margin, an SDE margin of about 38%. Believe it or not, dental practices, the median or the average SDE margin is right at around between 35 to 40%. So they make a lot of money. So you're thinking, wow, $500,000, that's a ton of money. This is going to get a pretty high multiple here. And so, which one is it? Is it 1 times, 2 times, or 3 times? And so let's go through the same table again. How involved does a dentist have to be in a dental practice? Well, you all know the answer to that question. Extremely involved. The dentist is pretty much the business, right? So there's a lot of personal goodwill there. So this automatically starts to bring the 2.75 down. What are the transferability of revenue risks? So how many of you would stop going to the dentist if he or she sold it to another dentist. That risk of attrition is pretty high, and so you're going to bring the multiple down. What's the size of a potential buyer pool of the business? How many of us on this webinar are potential buyers of a dental practice? I would assume that if there's no DMDs on this webinar, then none of us are potential buyers. So you decrease the multiple again because you start removing the potential buyers. Ease of operation, it's not really that easy to run a $1.3 million dental practice. You have to have hygienists, associate dentists, receptionists, and of course, industry risk. There is, believe it or not, industry risk. You see lower revenues when there's a recession or a weak economy because a lot of people don't want to spend that money on personal care. Just like gym memberships go down, you're going to defer your cavity filling until you have more money again. So all of these are going to reduce the multiple. And so, believe it or not, a dental practice will sell for about 1.75 to 2 times cash flow. And the reasons are exactly what's stated on this factors that influence the multiple. So while, some businesses like dental practices will sell for 2x, a franchise restaurant or a liquor store will sell for 4x, you have to look at each and every single factor of that business. For franchise restaurants, there's very little attrition. There's a large buyer pool. A lot of people want to buy a franchise. There's training manuals, there's franchise support, there's ease of operations, and a lot of franchises allow you to run the business absentee. An insurance agency is going to sell for 3 to 5 times cash flow because you have recurring revenues. What that means is if 7% of my customers don't renew their policy, all I need to do is make sure that my new customers are 10% of my business and I have a 3% growth rate and I'm good to go. So I don't have to do anything except get 10% new customers every year. There's a large buyer pool, including other insurance agencies, which drive up value even more due to investment synergies. And there's no customer concentration in most cases. Home health care, we do a lot of these. If it's heavily reliant on Medicaid, then it's going to be risky and you're going to have a low multiple. But if it's all self-pay, which a lot of these newer home health care businesses are, then you have very little risk and you're going to get a high multiple for that. So those are the factors really that every business or every buyer or seller needs to consider when valuing their business. And with just a few seconds left, I'm going to mention this one thing. I mentioned earlier that revenues are not a good way to estimate the value of a business. And I'm going to take that dental practice and I'm going to explain really quickly why. So we have revenues in a dental practice of $1 million. And these expenses are exactly as per industry expenses. So as I mentioned, SDE is approximately 35%. And so we have 35%, 350,000 SDE. If we use a SDE multiple on earnings, we have a value of 700,000. And if we use a revenue multiple, some of you may know that dentists typically sell for 70 cents on the dollar, then you have a value of 700,000. So you're good there. You could use either one. What happens if staff compensation goes up and your clinical supplies goes up? Then what happens is your cash flow drops to 250, but now the value of your business based on cash flow is only 500,000 versus based on revenue is 700,000. And therefore, I would argue that if your staff compensation and your clinical supplies are, you're $100,000 over market, your business is not worth $700,000 at this point. I would pay you $500,000, and then I would work my tail off for 6 months to fix the issues, and hopefully I'd have a $700,000 business again. So an inefficiently run business is worth an inefficient value. And so that's really the takeaway I want from the price to revenue multiple. Always use a cash flow multiple if possible. And hopefully you guys were able to get a lot of information on how to value a business just by looking at overall tax returns, first 2 pages. So I'm going to turn it right back to you, Nathan.
Great. Thanks, Neil, so much for the great information. I know Mel mentioned she's already got a lot of requests for slides. Thank you, everybody, for joining us. And I know, as I mentioned, Mountain Seed is working with Neil and Reliant to offer equipment and business valuations. Equipment is first, and then business valuations will be in the near future. So thanks, everybody, for joining. Thanks again, Neil, and we'll see you back next month.
Thank you. Have a great day.